Fed is easing interest rates and shows signs of continuing to do so, but mortgage rates have been sticky. I'm Neal Watson. Tyler Brautigan and I will show you what's going on behind the scenes and how to respond. That's coming up next. Hello, welcome to Wealth Wednesday. I'm Neal Watson, a certified financial planner professional, and joining me today is Tyler Brautigan, also a CFP pro. Tyler, it's good to see you again.
Great to be here, Neal. Big topic, lots of confusion around the mortgages, so very timely topic.
Yeah, so let's clear it up. Some interest rates are falling, but mortgage rates, they're not dropping nearly as fast, and here's why. Not all rates are the same. The Fed sets the overnight rate, and that affects short-term lending between businesses mostly. It will also affect your savings account and things like that. Mortgages usually key off the 10-year Treasury plus a little bit more.
So even if the Fed's cut rates, if investors want a bigger mortgage spread, quotes may barely move.
Right. So think your mortgage is close to the 10-year Treasury rates, and there's going to be a little bit above that, and that spread stays wide. Mortgages can stay sticky. Why is that?
There's a lot of different factors, Neal. A few that I'm going to touch on is the interest rate volatility. So between rapid or unpredictable swings in Treasury yields, it makes it harder for investors to model prepayment behavior on mortgage-backed securities. There's also prepayment risk, and that's when rates fall, homeowners refinance early, and mortgage-backed security investors lose higher yield bonds. There's also less demand in the mortgage-backed security arena. This will elevate the spread. And then also credit and liquidity risk. Investors could be worried about defaults long term. So these are just a few factors overall that keep the spread elevated.
Yeah, so basically it equates to more uncertainty equals a bigger investor premium, and that premium is what we're talking about when we talk about the spread. The housing market's also having an impact on this, isn't it, Tyler?
Yeah, low inventory. Owners locked into ultra low rates during COVID, actually, and this is keeping listings scarce.
So when supply's tight, lenders don't need deep discounts. Weekly averages also lag daily moves, so quotes on these mortgages are a little bit slower. Rates are drifting lower. How far can mortgages follow?
According to a research published in the Journal of Financial Planning, a 0.33%, we call that a 33 basis point cut in the federal funds rate, is associated with only about a 0.10 percentage or 10 basis point drop in an average 30-year mortgage rate.
So even a full 1% Fed funds cut might only show up as somewhere between a quarter point and 0.3% off of mortgage. So we're just going to expect a drift here and not really a cliff.
Exactly. So mortgage quotes depend more on Treasury yields, spread, and investor appetite for mortgage-backed securities. Progress is usually bumpy and it's not linear.
So this comes down to the big question that everybody wants to know with mortgage rates decreasing. If the mortgage rates fall, should you be refinancing? What factors into this?
There's numerous things as well with this, Neal. What we look at is rate savings versus cost. How much does it cost to refinance versus how much do you want to save on your monthly payment? The time in the home. Are you going to be moving soon? Is this your forever home? Plan on moving within the next 2 years, 5 years, 10 years. Look at the balance in the term. Consider a 20 or a 15-year term compared to a 30-year mortgage. If you've done a 30-year mortgage, look at what the current balance is, the rate, and the potential for lowering the term of the loan to maybe that 15 or 20-year term. Credit, income, equity, and PMI also impact this. And it's all about your goal fit. And when you're going to do the mortgage or looking at the closing, ask about a float down on your lock. All a float down is if the mortgage rates fall before your closing date, you may be able to lower that interest rate. And it typically comes with a fee from the bank to do this.
Yeah. So here's a simple example. You have a $400,000 mortgage, 30 years at 6.75%. Your principal and interest payment's about $2,600. If you refinance that at 6.25%, your payment drops to about $2,463. So you're saving about $132 a month or so. If you figure in about $5,000 in cost from the bank, the break-even point is roughly 38 months or 3.2 years. If you're not going to keep the loan that long, if you're going to move or sell your house, it may not be a wise choice to do that. However, it may be worth it if you're going to stay there for a while. You're going to save money in the long term. So here's a recap. Mortgages move with the 10-year Treasury plus a spread and then the lender costs, not one for one with the Fed things. The Journal of Financial Planning research shows that the Fed cuts often only translates to modest mortgage moves.
Yeah, so set expectations for a gradual drift potentially downward and not a plunge. And use the refi checklist that we discussed. Savings versus cost, your break even, time and home, and ultimately your goals.
So if you're looking for help on this and need help in doing the math and making a decision, give us a call. We can help you determine if a refi makes sense.
Again, and if the rates bounce in December, don't panic, just revisit the math.
So thanks for watching today, Tyler. It's good to have you again. If you like what you saw today, like and subscribe to our channel and bring your questions. We'll see you again next time.